Welcome everyone to our Stock Market Today video for July 26th, 2024. It's Justin Nielsen here. Allie's on vacation, so I'm going to be filling in for her, but we still have Mike Webster that's going to be going through this extended version of the Stock Market Today video. So welcome, Mike. How are you?
You don't look anything like Allie.
Well, that's I thank you for noticing, and I'm sure she thanks you too.
Both of you.
Right, exactly. That's probably a good thing. So we'll go over some of the market stuff, and then as usual on Fridays, we're going to go through some of the extended stuff in terms of Webby's RSI. We're going to go through some retracements, some levels, really dive deep on the market, and as always, we're also going to cover some stocks. Now, there was an interesting conversation. Dan Fitzpatrick was our guest on IBD Live this morning. Interesting conversation on 3M and not General Electric anymore. It's GE Aerospace now that all that breakup has happened. And then also ServiceNow. So those are the stocks you're going to cover today, right, Mike?
Yep.
Okay, well, let's get right to it. Let's take a look at how the indexes closed. It looks like the S&P 500 was up 1.1%. The NASDAQ Composite up a full percent. Dow Jones Industrial Average up 1.6%. And the one that also had the biggest gain was 1.7% for the Russell 2000. So let's start with the NASDAQ, shall we? I mean, you can't tell by this chart right now, but yesterday started looking like an upside reversal. And then it closed pretty poorly after getting resistance at the 50-day moving average line. What do you make of today? Inside day, up significantly, but was it enough?
No, I don't think it was enough. And yesterday's close was very disappointing because, as you said, midday, it looked like a very convincing upside reversal, which is normal when you have a nice pullback like that. Yeah, thanks for going to the interday. And I'm fighting a cough, so if I sound a little weird, that's why. We were looking really nice, and that is classic and normal. And you're always looking for what's classic and normal versus what's abnormal. And that sell-off into the close was abnormal, not what you'd like to see, but it wasn't enough to really throw out any of the upside reversal trades that you probably would have put on, earlier in the day, because it was just borderline and the selling really accelerated into the close. I think because of the economic numbers we had this morning. There's always, concern before, PCE numbers and CPI and unemployment numbers, things like that. So it was kind of understandable, the sell-off, but it was a little too excessive. Let's look at SPY on an intraday as well.
And this is 30-minute charts that we're looking at here.
Yes. And that one was even more disappointing because you could see that NASDAQ had been weaker, and SPY really looked like, it was going to be able to do something. And that last bar of selling, the last half an hour, was pretty excessive. It was kind of a warning sign. But we made it through the PCE alive today. And let's go back to the daily. I mean, it was up. And I kept on waiting for today for it to really have some momentum, because that red line there is the 50-day. Now, we always talk about the 21-day. That's something that I've focused on for, like 25 years or so, maybe 26 years. And but everyone else focuses on the 50-day, which is the red line, and the 200-day, which is the black line. The black line is a really important one. We'll talk about that on another session when we're closer to it. But the 50-day, lots of algos. Meaning,
that sounds a little ominous.
Hopefully not in this year, but we'll see.
Okay, just checking. I want to make sure.
No. If you get to your 200-day, it is a game changer. It's like that becomes night and day. That's a topic for hopefully another year, but we keep an open mind. So anyways, the 50-day is kind of that guardrail, as we always like to talk about, is, things go up and then they come into the 50-day. And that's where most institutions like to support stocks or indexes, because unlike us, who are fine kind of buying things, breaking out or up and sometimes extended, they really, as general rule, like things, they're more price sensitive. were more time sensitive because they have a low turnover. I'm talking about big mutual funds and slower hedge funds. So they support around a 50-day. And when you act like this, it's kind of a warning sign that we might not be over with that correction. Now, how you know for sure that the wind is now at your back is if you can get your low above that green line, which is your 21-day moving average. We're going to be talking a lot about that throughout today's session. And, that's a long way from here, for our low to get above that. And you did get your low above it like 3-4 days ago, but you closed down. And so when we say you're low above the 21-day, we really mean in a constructive day, not just that it's above it. So with why don't you tell them about our market school rules while I cough?
Yeah, sure. And the market school rules that we kind of came up with, this was Mike Webster, Charles Harris, and I over a decade ago. One of the issues that we look for is that 21-day moving average line. Can you get your low above it? Can you trend above it for a period of time? But we don't count that as a buy signal unless you close up. We want to be closing up. We want to. We're always looking for those signs of strength. So that particular day that Mike was talking about, while the low did get above the 21-day moving average line, it was not a signal to buy because it closed down for the day.
Yeah. So along those lines, by the time our low gets above the 21-day and it's in the right type of move where you close up for the day, preferably near the highs of the day, that would be your signal that, hey, look, the trend is changed and we're back up. That's a long way from now. So you have to decide, are you willing to wait until you get up there? And there's not a right or a wrong answer. It's just how you are wired. Are you more price sensitive or time sensitive? I would say in general, most people should wait until you get your low back above it and sacrifice and not get the better prices, unless it's a day like yesterday where you had, before the terrible close, you had an upside reversal. That's kind of the rare exception. When you have an upside reversal, which is what it looked like until we rolled over late in the day, that's where it's okay to actually start buying relatively heavy because then you have a line in the sand. Your line in the sand becomes the low of that day. So that would be your exception. We'll talk about that in future weeks if one of those days happens. But right now for SPY
and just for an example of that, I mean, this day right here back,
May 31st, right?
May 31st. Yeah, that was a really big dramatic reversal day, right? I mean, things looked pretty bad while we were at the lows, but then we got this, major reversal by the end. Everything was fine, right? And even more than fine. It was, closing at the top of its range. The low didn't get above the 21-day moving average line, but that is your classic upside reversal look.
Yeah, and that's the one at the end of the day you really want to put on the gas. And that was a very tricky day because it looked so bad in the morning. And what you really want to remember is these key moving averages that others use, like a 50-day and a 200-day, when you get close to them, they kind of become magnets, and the bears try to push it there because they know once it gets there, lots of algos get triggered, and then the selling accelerates. So you want to be careful around these moving averages, and that's why we prefer to have the low above it. So then it's real proof that you've gotten above that moving average, with the rare exception of a day like that, like the May 31st upside reversal, big spread closing at your highs. That's a sign that things have changed. And again, if we had a way of showing yesterday midday on here, it looked very convincing. And so you have to take those shots, and then you have to back away if they don't end up working out.
As another example of that, if you think about this correction that we had back in April, I would say that one of the key days was this May 3rd, where we got the low back above the 21-day moving average line in that case, and really kind of broke that downtrend. So another good example of what we're talking about there. Now, one of the things that was interesting about this May 31st day that we were talking about on SPY here was the look of IWM, the Russell 2000. This is the iShares, Russell 2000 index. And on that 31st, it was a day where this was up pretty much the whole day.
Yeah.
And it looked like this rotation was happening. And then it didn't. We had all these, what we called rofactions. But then on July 11th, this is where things kind of changed for IWM. So maybe talk about where we're at now with this index. I mean, it came down pretty hard last week, but it seemed like this upside reversal on Monday, it's really kind of held well.
Yeah, so we have a major divergence in the market, and that happens. Doesn't happen all the time, but it happens occasionally. And that was the changing point. Let's go to the monthly on the IWM and just look over the last few years, all these head fakes that have happened. Well, maybe we'll go to the weekly. It's probably easier to see there. That you had all these little bases that formed. A couple of them pattern rec picked up, but there were other ones in there where it looked like it was going to go, and that's why Gessel or Dominic Gessel had coined the phrase "rofaction," just because there are all these head fakes, month after month, actually year after year at this point. Now it looks different. You can see on the weekly chart that RS line has so much space between its moving averages. It's clearly in the lead right now. I can't remember if I said I do have a position in this one.
I do have a position as well.
Mm-hmm. And of course we have it on Swing Trader. So let's go back to the daily and kind of see what's happened here. It gapped up, and that was a significant gap that we had. Right there. And you closed nicely. You closed above the 209.77, which was your high of your cup with long handle that we had there. And even if you don't look at it as a cup with handle, it was clearing that space. And then the next day, you got even more momentum. It did close in the lower part of that bar. But if you take the true range from the prior day's close, that actually looks pretty good. And then you had a nice move up. And of course, you have to have give backs, or what a lot of us call just like natural retracements, natural reactions, depending on the terminology you prefer. But basically, just a pullback to see if it's going to stick. And I like to use the 50% retracement, which we'll get into in a little bit. And that held, and now is building what I call a little shelf, where it's just pausing sideways, digesting, and at the same time, the rest of the market has been, choppy to selling off. So this is where the money is going right now. So our job is not to predict, but to interpret. And you want to know what's healthy and what's not. The simplest way is just to see, where are you staying above the 21 day? Where are you below it? And this is that green line there is your 21 day. And we've been holding well above it ever since that breakout. So this is now a small and mid cap market. Let's just pull up MDY, because it's basically very similar there, just not as strong, because that little shelf that it's forming right now is a little bit lower than the position of the IWM, but it still looks strong. So I think these are, and that RS line has really powered through both of those moving averages in a big way. It's pointing up, very, very sharp angle. So this is where all the money is flowing, that's coming out of those big caps. So this is the pond efficient, in my opinion.
Well, and since we're talking about that kind of small cap, mid cap area, it's worth mentioning RSP and QQEW. These are the equal weighted versions of the index. And look, RSP, that's still the top 500 companies, right? It's still those big cap companies. And, the QQEW is still those top companies, those top 100 companies on the NASDAQ. But it certainly seems like there's more of tech, which NASDAQ is much more tech focused. But, the top 500 companies, RSP doesn't look too bad when you do an equal weight. Again, that kind of takes away that big market cap weighting for your Alphabet, your Microsoft, Apple, Nvidia, those big guys, $1 trillion club members. So what are these equal weighted ETFs kind of telling us?
This is the breadth that everyone has been wanting. All the bears or people that weren't really bearish, they just weren't bulls during the run that Qs and SPY were leading. They were saying not enough participation. And there wasn't. They were right. Now we're getting that. So what everyone has asked for, we are getting. They didn't want just the $1 trillion club to be driving everything, and so they're pausing. They're not breaking down and falling apart. They're just base building, doing what is normal and healthy. Like look, Google is come down a bit, but these are normal pullbacks. It's not blow-ups. You just don't want blow-ups in those. If you get blow-ups, then that's different, unless it's a one-off news item that's very specific to a stock. If it's for an entire group or sector, that's problematic. But they're forming bases. That's what you want them to do. Yeah, in the FNGS, which are the 10, of those big caps, Snowflake is also in there.
I'm not sure why Snowflake is in there. That just seems like it doesn't fit, but maybe that's the S in FNGS. I don't know.
Yeah, I'm not sure. It was a hot stock probably when they formed this,
Sure.
but
Yeah,
it's not hot anymore. I mean, it looked really promising back in the day. But anyways, going back to the FNGS, that really represents what people call the Mag 7. So I would keep a close eye on this one. You want to see this just base out. This looks like the left side of a base, and it looks like it could come into 45 and still be normal. So again, the theme is always what's normal and natural and what's abnormal, and then you just pay attention to the two. So this is a normal base. It just means, hey, unless you have a really low cost basis in these things, you don't play there. It doesn't mean, if you've got NVIDIA with a really low cost basis that you blow it out. It's just that if you have a high cost basis, you blow it out and you wait for it to set back up. Same thing for the rest of those.
Yeah. Let's chat a little bit, outside of kind of just these major indexes. If you don't mind, we can go through the sector ETFs real quick.
Sure.
And we can just kind of go through all 11, bang through them in short order. I'll start with the worst of the day, XLE, energy.
Yeah. So when you're looking at these, I like to focus my eyes on that RS line. And you know what? The RS line in general has been moving up over the last 3 weeks. So this is a place that I would look into these stocks. There's some that are acting okay, other ones that didn't really pan out. But this is an area that I would look into.
Yeah, and of course, ExxonMobil and Chevron are kind of the heavyweights in here. Those two together make up over 40%. But sometimes I like to look at XOP to kind of get a sense what's happening with the explorers and producers, and OIH is the field services. And we were talking about this one today. That kind of looks a little interesting. So,
well, you were bringing this one up yesterday, and we as something to put on Swing Trader, and we were debating whether or not to do it. And one of the heaviest weights in there was, I think it was Baker Hughes, and that was reporting today. So we just didn't want to step in front of that earnings report. But now that that's out of the way, yeah, the OIH does look very interesting, and great job on picking up on that. Go back to the OIH, and why don't you walk them through what it was you were seeing there yesterday?
Well, really, it was, again, kind of what we've been talking about, that upside reversal. We were looking at it intraday, and by the end of the day, I mean, it was an outside day closing near the top of its range. So I've been kind of watching this area because, again, XOP, the explorers and producers haven't been that exciting. OIH was even kind of, middling for a while there, but it did seem like a lot of the machinery equipment, Baker Hughes being one of them. I think, FANG is in the U.S. explorers and producers, and that's been holding at the 50-day moving average line. Weatherford, is also in the machinery equipment that kind of came down. So it's been very mixed in this area.
And the SLB, I think, is the biggest one in that OIH, and that one has been dogging it.
Oh yeah, formerly known as Schlumberger, but now
they changed it. So they specifically in the press release they changed it. They said, so Webby can actually pronounce our name. We are
exactly. Stop saying Schlumberger.
Yes.
So let's talk about XLV. This is healthcare, also a pretty nice relative strength line.
That's where you want it. That's the pond to fish in.
XLU, we've been talking about this as typically more defensive, but this was almost like AI adjacent for a while during this move, as people kind of realized the power needs of EVs, these AI chips, all of these things that require so much more power. How is this looking like to you now?
That's a mixed bag because there's so much, like you said, there's the AI related ones, and then there's just the normal utility ones. So it's worth playing through them, and you can just do a quick screen for ones that are, within 15% of their highs, above their 50 and the 200, and even their 21-day, and just look at those utilities because a lot of them still look junky. But I would look at them. I wouldn't put, I wouldn't make them a big part of your portfolio.
Over at the consumer staples for a while there, it seemed like this was getting some traction as maybe a correction was unfolding. This does tend to be on the more defensive side. You've got your things like Campbell's soup and Hershey's, Coca-Cola. But what do you think of XLP right here?
Yeah, and I think Procter and Gamble is one of the biggest
Procter and Gamble,
there, and then Costco as well, I believe. And so I do think that this one is another kind of like the utilities. It's a mixed bag, that there's some that, like Costco, which I'm a huge fan of. It just looks like it's forming a normal base, and in the normal base, the way Bill O'Neill, the founder of IBD, would look at it is when something is coming in, you say, okay, where should it stop? And he would typically say, okay, it should stop somewhere around the top of the prior base. So the 787.08 is an area where that would be normal for it to get some support, but it's also right around that 800 psychological level. So I'd be looking for this one to round out, and hopefully it gives us an entry point 3-4 weeks from now. That would be great. So it's one I always like to keep an eye on, but I don't like buying things under the 50. XLY, that's a mixed bag with some heavyweights in there. So I would just avoid that one. The RS line is underneath the moving averages right now.
XLK as the tech, this has got a lot of NVIDIA and Microsoft in them.
And again, with this, I would just focus on that RS line is in a downtrend underneath those moving averages. So I would avoid this area.
XLF, the financials.
This is where this is the pond to fish in. Not necessarily the big caps. The big caps look okay, like the Goldman Sachs and the Morgan Stanleys. The Berkshire looks very interesting. The Berkshire B, it's broke out, it's pulled back in, a natural pullback. Looks like it wants to go higher. But for the first time since I can remember, in my screens, I'm seeing tons of savings and loans and small banks. They look great. They're just kind of out of position. They've already run up so much. So yeah, like the KBE, great one, nice cup with handle. I've just been kicking myself all week for missing that breakout. But we all have this kind of negative bias towards savings and loans and small banks because they just really aren't part of the models that we've studied. But with this interest rate environment that appears, or at least the market thinks, that the interest rates are going to start coming down, that Powell and company are going to start cutting, that becomes better for both real estate as well as banks. So that's the pond that I would certainly, your homework for this weekend is to screen through all of the banks and all of the savings and loans, basically anything over $10 that's above its 50-day and above its 200-day, and it has a basic liquidity that you're comfortable with depending on your account size.
But again, be careful. A lot of these are extended.
Very extended, yeah.
Yeah. Speaking of real estate, here's XLRE, another one. Man, look at that. Look at that relative strength line.
Yeah, you can see a little downtrend there. Sometimes you can just play it using the ETF, and that's what I'd probably do with the XLF at this point, or the XLRE. If you can break that little downtrend of this little handle that it's forming, kind of a high handle, that's where I think you could enter that one.
XLB, the materials.
Look at that, like a nice double bottom. I know it's showing up as a flat base or a consolidation or a flat base, but a nice double bottom with a handle here. And so I think that looks poised. I would play through. You can go on the Spider's website, and there's a place where they have all the holdings. You can just take those, dump them into Excel, and paste them into Market Surge and play through all of them, because that is certain. Look at that RS line is just smoking, and it's in position that's where you want to be looking right now.
Also, industrials kind of having a decent relative strength line here.
Yeah, same basic thing. Yeah.
And then XLC today, the communications, this has a lot of Meta and Google in it. So this one, relative strength, a little bit tougher.
Yeah, I would avoid those. Some of the, the AT&Ts and things were looking like they were going to go, and they got hit a little bit. So I would just avoid that area unless there's a one-off in there.
Let's talk a little bit about some stocks, and we can start with 3M. This was, again, a conversation that we had today on our IBD Live show with Dan Fitzpatrick as our special guest. You were on there, and man, this is usually, you think of the slow, pokey, old industrials that just don't typically move. Here's the monthly chart on it. And I'm sorry, but that relative strength has a lot to be desired. But today, wow, it really showed some strength after its earnings report. What's happening here?
Yeah, so you always want to keep an open mind to things, because things do change. And anyone who watches IBD Live and missed that segment, I would go back and rewatch it. Dan was great. That I think we went into this in depth that we can't do during this time, or this would be like 3 hours long. But if you don't use IBD Live, I think we've got like a really cheap trial or something. I would give it a shot. I think it's great. I thought it was great even when I wasn't on the show. I watched every day for the last year. So anyways, in a nutshell, go back to the monthly. That this was back in the day, it was a big stock, and then it's been just a dog for a long time. But things have changed, kind of like the GE that we're going to talk about. They had a spin-off. They're separating some divisions. So it's what we would call a turnaround. Can we go to the weekly for a sec? And you can see that green line there, that's your earnings line. And the earnings are turning around. They've fallen off a cliff. And then given enough time, a good buddy of mine always used to say stocks will follow their earnings. And so that's what's happening. The earnings are starting to go up, so the price is going up as well to match. And I think this has a long way to go. Now, it's super extended at this point. And let's just go over those bases, because this is very important. Hover on that first base and show the depth. If you go a little lower, yeah. So 25% deep was your first one. Now the next one was 18%. And that's exactly what you want to see. And then 9% deep. So each one getting tighter, that's telling you that it's more at a point of equilibrium. People are more comfortable with that current price. And you can see all those blue shaded areas. Those are where it's 3 or more weeks that are tight. And that's another sign of accumulation in there. And now you have this power from pivot where it ripped up out of this base. Let's toggle over to the daily for a second.
One more thing about these bases, not only are they tighter, but what you really like is that the lows are above the prior low each time. So that's kind of the definition of an uptrend. Back to the daily.
Excellent point. And so now it's so extended, you can't really buy it here without taking on a ton of risk. So what we're going to be doing is watching it for the next few weeks, see if it can tighten up and form some sort of area of resistance. Or if maybe 2 weeks from now it's doodling around in there, and then it has a shakeout with an upside reversal, that would be the ideal place to start a position. So you don't want to forget about this one and say it's too late. You want to keep it on your watch list and watch it every day. But I probably wouldn't buy it for a couple weeks. And look at that RS line is at new highs, and that's where you see that little blue dot there. It's just part of the thing that we put with pattern rec, that if it's in a base and the RS line is at new highs, or it breaks out of a base and the RS line is at new highs, we wanted to highlight it for you. And so we have that little blue dot.
Yeah, usually we talk about, you'd like to see that relative strength line kind of at the 1 o'clock, 2 o'clock angle. It's not very often that you see something at like 12:05 in this case. So, now, one of the things that is kind of making 3M a little bit more exciting is that you've got a CEO in there that is really wanting to kind of change, turn the ship around. And, it takes some time, but really kind of shedding a lot of the unprofitable areas. And, there was this kind of some of these diversified operations. I mean, they had their hands in a little bit of everything. It was just kind of a mix match of all sorts of different industries that they were in. And now this is just trying to kind of consolidate to what it's best at. And that's a little reminiscent of GE, which, I mean, remember GE at one time, it had light bulbs, it had, airplane engines, it had appliances, it had NBC, it had like a little bit of everything, right?
Yeah, in very similar situation, and you read my mind going to the monthly. It's like the 3M. It's been a dog for a long time, but it had its turnaround already. And that's what I think, if you go, you don't have to switch to it, but if you think of the 3M, where it's at now, it's almost like GE a year ago. It kind of gives you that same feel that like now people are starting to believe the turn. Let's go to the weekly on this one. And again, it forms these nice bases. The last two flat bases have been very tight. So it feels like it's under, steady accumulation. People aren't just, it's a little different than the 3M, where now all of a sudden it seemed like new people just came in. They're saying, just buy it regardless of the price, just get me in there. It seems like they've been more methodical with GM, and it's been, or GE, and very, slow and methodical, and many weeks in a row up, which is another thing that Bill O'Neill, discovered, decades back, of 5 weeks or more in a row is a sign of steady accumulation. This has way more than 5 weeks in it. So I tried to break out earlier this week and kind of got pushed back a little bit, but I'm still watching it, and something we might get back into.
Mm-hmm. And then as a reminder for folks, they did have some spinoffs, including GE Vernova, which is kind of on their energy side, alternative energy side. And also not too long ago, the GE Healthcare got spun off as well. So that was something that had been in the works. And now you've got a kind of a leaner, meaner GE that is, now more focused on that aerospace side. And that's been an area to be in, because as we see from ITA, which is the iShares US Aerospace and Defense, this has been looking a little bit stronger lately, as this rotation has unfolded.
Yep, totally.
Okay.
Agree.
Let's take a look at ServiceNow. I do have a position in this myself. This is also on Swing Trader. Not much that you could have done with this before the earnings report, but man, that earnings report really kind of changed the look, huh?
Yeah, I bought it back to, after our 30-minute window that we have to wait for when we put it on Swing Trader yesterday. And, I think it looks really good. Now, the possibility of it coming down and even reaching 800 that would probably shake us out of a swing trade is certainly there. So you want to be cognizant of that. Doesn't mean that it's going to happen, but that certainly could. And, from a swing trading standpoint, when something has a big move like this, you're kind of at a disadvantage, because you want to keep your stops tight. But there's also what's normal and natural. And what's normal and natural is this could come all the way down And as long as it holds above the low of that breakout, it's normal and natural, but that would be too much for us to withstand from a swing trade. So I would probably be out of it at that point, and we'd have to back out of it with swing trader. But it doesn't mean that you would have to. If you're doing it from a position trading standpoint, you can give it the full 7 or 8%. Let's go to the weekly on this. This is a fundamental play that we're doing because the base has got problems all over it. If you know how to do the week by week analysis that Bill O'Neill developed and taught while he was with us, that if you go through that week, that base week by week, we don't have the time to do it now. And you just, a technique that I used to do is I would mark good weeks with a blue or a green pen and bad weeks with a red pen. That there's a lot of bad in there and there's some good, but this is really more of a fundamental situation. And the depth of that base, what is that? So that's 22. And what was the last one that we had? 14. So it's going in the wrong direction. So just about everything about the base is problematic. But let's go over to the quarterly numbers and scroll down. And you can see that this is really why we're in it, is from a fundamental standpoint, plus we have an entry. And really my focus is on that sales growth, that, those are big numbers that it's bringing in, every quarter, and it's still growing in the low 20s steadily. And big institutions like that, they like steady growth, predictable earnings, but really predictable sales growth is very important. Same thing on the estimate side, has strong numbers there. Let's go up and see the rest of the numbers on here that we normally don't talk about. On the left side, your annual numbers, Bill would always like to see 3 years in a row where each year it's higher than the prior one. And we've got lots of years where each year it's higher than the prior one, plus good annual estimates. EPS rating is 99, which is as high as it gets. Your composite rating is 95, which is solid. So everything else is really good. That earning stability is really what stands out at 4. That's on a 1 to 100 or 1 to 99, but with 1 being your best number, it's the only time where it's reversed. That's just showing that it's very stable and predictable. So this is a fundamental play, not a technical play. The group has problems. We saw with CrowdStrike that we've been talking about quite a bit, that had the debacle last week, and that one's really in the penalty box for me for months, if not a year after an incident like that. So it has some headwinds because technology isn't working right now so well, and the software is problematic. So this is not a slam dunk, but we're giving it a shot.
Okay, let's go ahead and if we can switch over to your TradeStation charts.
Sure.
One of the things that we typically do on this session, we go through some of the regression lines, and you're going to add a few. So normally you talk about SPY and Qs, but we can add a few to this conversation with IWM, RSP, MDY, and FNGS. Take it away.
Yeah, I'll try to be quick with it because I know we have so much to go over. So this is the weekly, and we always like to do the Bob Weir, take a step back and look at the weekly to get a bigger picture of things. And this is SPY. And of course, you had your really serious, nice trend that you had here with these regression lines. Then it broke that. Then it restarted this other trend. And now it's broken that. So now we just have to wait for it to work itself out. But it's out of trend at this point. Same thing with the NASDAQ. We had the original trend that was nice and steady. It broke out of that in April, then came right back in May, had that nice steady move up, and now that has fallen out as well. So that one is now gone. And now we're going to, let's take a look at the RSP. You can see with RSP on the same time frame, that's really not done much. Certainly during this time frame, since really the beginning of April, it's gone sideways. Base build, it's been base building, and it looks like it really wants to move higher. And then here, this is really where it's at. The IWM on a weekly, 3 weeks into a solid breakout, and just looking really strong right now. I guess we could toggle over to the dailies if you would like, Justin.
Yeah.
Okay, so here is SPY in the regression that we always go over. This one, we have 2 lines on it. If this is your first time with us on SMT, welcome. And we have the regression starting on April 22nd, and we ended it 50 days later on July 2nd. And we have a 0.75 and a 1 standard deviation above it and below it. All this is it just means during that time frame from April to the beginning of July, this was the trend that it was in, and those are the the standard deviations away from that trend, the line of best fit. The reason why we use this is because we want to see when it breaks trend, and when it comes down to those green areas and bounces convincingly, that's where you really gun it. But you can see that it tried to bounce, stalled here, and then it broke through these. So this trend is dead at this point. We're waiting for, doesn't mean a new trend can't start, but we don't know. Could that start on Monday? Could it start 2 months from now? We don't know. We keep an open mind, but this trend is dead. Let's take a look at NASDAQ, and even worse there. So same dates, the April 22nd to the July 2nd, and the same types of regressions on there. And that broke well below that. And this is why I think everyone should utilize this type of tool, because it does help out a lot. And then we'll just toggle to the IWM there. I started this regression. I started it on July 10th. It's debatable whether you started on July 10th or July 11th. This is an art, not a science, but we don't really have enough data points yet to determine, excuse me, the current trend here. But we'll start looking at this each week, because this is our benchmark that we're using for the time being.
And as a reminder for folks, a lot of times when a trend starts, again, until you get more data points, you often will have a very steep uptrend that is obviously unsustainable. It's going at an angle that just, it's not going to continue at that angle. But as you get more data points, it does tend to widen out a little bit, and the angle tends to get a little bit more realistic. How many data points before you really kind of say, oh, this is something I can trust? Or is it, it when you see it?
You kind of know when you see it, but I would say it's somewhere in the like 25-ish. I stop it at 50 days, but I'd say 5 weeks of daily data points. So 25 days is about where where that trend is. To show your point, if we just did this to these 3 days, right, or these 3 or 4 days, that's unrealistic. And that's another way of, when you're in that situation like that, expect a pullback, because it can't be sustained there. And I'm just going to toggle back, because it is an important point on the composite and why we stop it at 50 days. Because if we continue out and make this out to the current time, and we do that with both of these, you can see that it just data fits, and that it'll always just kind of, you'll be like, oh, okay, you can make excuses to yourself that, oh, it's still in the trend, it's still in the trend. So that's why
one day out of it. You find that a lot of times. You're in a downtrend. Oh, it's just one day out of the trend. I'll give it a chance to see if it can come back in to the trend.
Exactly. So that's why you always want to stop it at a predefined point in time. I'm not saying that the 50 days that I use is magic. It's just what I like to use. So I guess we can move forward to the 50% retracement, if that's okay.
Yeah. And this is really interesting. I don't know where you want to start, because SPY and the Qs, that those have kind of been below their 50% retracements, whereas IWM has held above it. So it's a real interesting kind of show of strength for IWM, right?
Yeah. So I guess we'll start with the laggards first, and we'll move into the ones that are working. And so we're going to be using different levels or different starting points and ending points for these 50% retracements because of just the way the data is. And so with this one, with SPY, we're starting on May 23rd, and we're going up to our recent high, which was on my mother's birthday, the best mother in the world, and she watches every a week with my dad, the best dad in the world. So hi guys. So to that day right there, that's your move. And then you always tell yourself something can retrace 50% of that and still be normal, natural, and healthy. Once it starts going below that and living below that, that's where it's a problem and it's a sign of weakness. So our midpoint there, it's living below it. So this is another reason to avoid this space. We'll look at the composite, the NASDAQ. Same thing there, same basic dates. It's living below that. Another thing to look at is the one that you brought up earlier, the FNGS, which is your FNGS, which is your Mag 7, your biggest stocks. And this one looks terrible, right? It retraced everything. So it was 100% retracement, or in other words, it was a round trip, something you really only want when you're flying places. So now let's toggle over to the RSP to get a different picture. Now we're starting this one on July 10th, because that's really kind of the day before the gap up and the major shift in the market. And that's run up to the 18th, and then came back in and is dual round, and now it closed decisively back above that midpoint today. So that is a pond to fish in. We'll look at the mid caps using the MDY, and the same thing here, same dates. It's looking even better than the RSP, so that's looking nice. And then the one that's kind of leading things. And by using this technique, you can clearly see which one's leading, which one's lagging by where it is within that retracement. And the IWM is almost back up to those highs that it hit on the 17th. So,
and that retracement, by having that in place, when it did pull back, it was a little bit less worrisome because you knew, oh, okay, it's still, even at its worst, that upside reversal that it had just a week ago, it got right to that 50% retracement level and bounced.
Exactly. And we've done something do you want to talk about what we've done with Swing Trader with this, or
with IWM? I mean, yeah, this was basically, recognizing that this is something, on that July 11th, when things turned, that the rotation plays really seemed to kind of catch on and be for real. We started building the position then. I think we did trim a little bit, but then we put the position right back and went a little bit heavier. So right now, this is actually a double position for us. And again, I have both Mike and I have positions in this ourselves, but I mean, it's been holding the 10-day moving average line, hasn't even tested the 21-day moving average line. So now that we have some progress on this, we can actually kind of use that upside reversal. If it does break down below that, that's going to be very telling that, maybe this has got some weakness that it's got to get through. So that can be a place to kind of make sure that we don't get caught in extra weakness, whether you trim a little bit there or exit the position, so you can keep some of those profits that you gained from the early move.
Excellent point, Justin. And on top of that, the 50% retracement level happens to fall right there at the low of that upside reversal that we had on the 22nd, but also pretty much where the 21-day moving average is going to be. So when you get multiple things giving you the same area of support, that level becomes much more important. And so that's why we felt more comfortable, as comfortable as you ever get, by building a bigger position with these 2,000 stocks. One, it's really spread out. And then two, you have this nice exit. If it goes back down there, we'll have round tripped and we'll have to exit it. But you always have to have a line in the sand. And so it's nice when they all collide at the same place.
Mm-hmm. So, great stuff here on the regression and also on the retracement. Maybe now we can kind of shift over to your Webb RSI. And for those of you that are thinking about RSI as that relative strength indicator, this is a little bit different. This isn't using that more sophisticated formula. It's not a stochastic or oscillator. This is a lot simpler. And so the RSI in this case stands for really simple indicator. So Mike, why don't you go ahead and show your trading view? And
yeah, so I'm gonna, Lily, just a heads up, I'm gonna toggle out of this earlier, and I'm gonna go ahead and share with you I'll just take a second for me to stop share. And it's my weakness in life is pulling up the right one. One sec.
Yeah, it's much easier to do all of this toggling back and forth because you multitask throughout the day, but when you have to share it, that's where it gets a little bit trickier.
Yeah. Okay. Can you see?
Yes.
Okay. So let me toggle to the Webb RSI on SPY. Okay. So this indicator is, we typically are looking at the blue histogram down here, and that is the blue is your low versus your 21 day. But in this second version of my Webb RSI, which I called my version 5.150, because that's how I like to roll, that I've changed it from percent to ATR, average true range, but I've also changed it to where your high is now this kind of brown orangish histogram down here. That's showing you your high versus your 21 day. You do not want to see this brown, we'll just call it a orange down here. That's telling you you're in an area of weakness. You want to wait for that low to get above your 21 day. So this is another way of just quickly seeing that, hey, it's time to not play here unless you get those upside reversals like we had yesterday. That one didn't work out. Let's look at the NASDAQ, same thing. Those are getting even higher. Now, what you will find is when your high gets so far below your 21 day that it becomes oversold and really prone for a bounce. And those are the times where you're really looking for, upside reversals in there. So when you see these brown areas getting higher, or orange, whatever you want to call them, spiking up to 2 or 3 ATRs underneath your 21 day, that's where you're looking for I guess most people say buy on the dip, but we like to buy on the strength after the dip. But what we can see here is the FNGS, which is FNGS. Those are spiking up really high. No surprise there. But here's the RSP again, the 500 equally weighted, and that is looking nice. You had some power right here, and when you start a new trend, you want to see power, which is displayed by big histograms. You can even get over 3 ATRs when the move starts, and that's healthy. You do want to see a little bit of a give back. That's exactly what happened here. But the sweet spot is half an ATR, which is exactly where we are at right now. Half an ATR to 2 ATRs is kind of your nice trending zone. So we're right there right now. So that looks beautiful, frankly. And IWM looks even better because you have this power. It came in, it's held above 1 ATR the whole time. Now we're back up to 2. And so this would still be normal and natural for it to, even expand as early as next week. And, for your first few weeks, seeing a lot of power there, your distance from your low to your 21 day is ideal.
Very good stuff. So shall we wrap this up with a move back to your what is the name of this? Your Bob Marley?
Yes, the Bob Marley, my daughter's favorite indicator. She's not so much of a fan of Bob Marley as she's a fan of something that she could remember when she watched this one time. She's like, Dad, I really like your Bob Marley indicator. And that's just because of the colors. And really all this is doing is telling you, is it normal or natural? And how it is designed is your how far off your highs you are based on in terms of ATRs. So green.
So this is kind of like what we saw with your brown histograms on a lot
Yeah.
but when we're below the 21 day.
Exactly. But this is versus your high. And so this is the green area is a place you want to stay in. And that's where you're still within 4 ATRs of your high. The yellow is 4 to 8 ATRs. Anything more than 8 ATRs off your high, you're kind of in some serious problems. And so this came down, bounced a little bit. We'd like to see it get into this green zone quickly. This isn't as problematic as if you look at the NASDAQ, it's well in here. And what's good about this indicator is you can see from this trend that we've had, starting with the 3 waves down back in, starting on November 1st of 2023, you've pretty much stayed in this green zone the entire time, with the exception of a little bit in April for just, a couple weeks from April 17th until April 25th. So a very short period of time where you were in the yellow zone. Now we're even further in the yellow zone. So another reason to stay away from that. We'll just do 2 more real quick because I know we're really late on time. Sorry about that. The RSP, you can see that really since April, it was running into some trouble. Now it's getting back up and it's still in the green area. We want to see it stay there. But the monster one now is the IWM. So we want to pay attention to this. And frankly, this low here, about 3 ATRs off the high that it had on this pullback a couple days back around the 22nd on Monday. That's where we wanted to stay above, because that's its first line in the sand. It's saying that it went up. What is its natural pullback? At this point, its natural pullback is 3 ATRs. So we don't want it to go more than 3 ATRs off its high, or we should expect further weakness.
Very good. Lily, we're going to go ahead and switch back over to Market Surge. We can maybe check out some of the different areas. So I'm going to go back and share my screen. And, one of the things that you typically do with Ali is take a look at some of these breaking out today, near pivot, recent breakouts. On the breaking out today, there is that Baker Hughes that you referred to earlier. So interesting that did make the cut there. Again, quite extended, with a 6% move today. Also, IBP, this is Installed Building Products. What do you think of this one? This is a double bottom that it's breaking out of. It at least did have this little pause right there right under its 257.45 buy point.
Yeah, so this is one that I will be looking into over the weekend. Unfortunately, earnings are right around the corner, which you can see their EPS due in 6 days. So that might keep me away from it. But what I would do is look at all the other stocks in the group and focus on ones that look good, that have already had earnings reports out.
Yeah, and this was a big week for earnings. Next week is also a big week for earnings. So you're going to probably find that by the end of the week, we're probably going to be like, at least 50% through most of them. These 2 weeks are kind of heavy in that regard. Some other areas to look at: the near pivot. It was interesting that as I was looking through this investment management, the finance, we talked about XLF, that had some in this near pivot. Also Woodward, which is in the aerospace defense. We talked about that being a strong area. One area that we didn't talk about was leisure, gaming, and equipment. And this is Churchill Downs, CHDN.
Yeah, what's nice about that is the earnings are already behind you. I don't like the action that it had yesterday where it was trying to go. Essentially, that was an alternative pivot. If you can draw a downtrend in that handle, that it broke out and then it failed late in the day, like a lot of things did. So that would be, a point against it, but certainly something that you want to do some research in over the weekend. And the earnings are behind us, as I think we said.
Mm-hmm. Now, in the recent breakouts, there's a lot more. There's 88 stocks in here. I'm just going to blow this up real quick and let you kind of look through this list. And by the way, this is kind of putting Mike on the spot here. But anything that, but he can handle it. I believe in it. I believe in him. Anything that's kind of catching your attention here?
Let's sort it by dollar volume. If you have that as one of your items. If you don't, it's okay.
I do, but
don't worry about it. Do the weekly change.
Okay.
If you don't have that, since that's what you have there, just so we have something to buy the best first. Yeah. So in here, what you're looking for, I would play through all of these. Let's take a look at KBH, DHI, and Coop, which are in the middle. Yeah. Or you can start with the tri-point, which is above it.
Mm-hmm. And this Green Brick Partners is also in the building residential commercial.
So this space is kind of hot. I'm in the XHB. We also have it in on Swing Trader. I think that using ETFs in the home builders is kind of the safer way to go. You will get a bigger move out of the individual names if you pick the right one. So I would look at all of them in there. The Green Brick is a little bit extended. Same thing with the tri-point.
A lot of these might be.
The KBH, that one is actually formed a little shelf here, and it's not that far out of it. So what if you're a swing trader and you want to get back into it? Because we did a swing trade in this one, I believe, and then we locked in the gains. But this is actually a place, if we didn't have the XHB already on there, that we could have bought it back today because it cleared that little shelf, and then you would just use yesterday's low as your stop, or the low from last week as your stop, and I think that would be fine.
And one of the reasons we didn't do that is because we do have an outsized position in XHB, so we are getting that exposure. We actually added to this position, and that was kind of our move in that space. And I do have a position in XHB, which I believe you also disclosed that you do as well. So DHI, kind of a similar thing. It did kind of dip back down in that shelf a little bit. And then you also mentioned Mr. Cooper, which is in the consumer loans area. So a little bit different.
So what I would do as your homework this week, and I think I said it at the top of the show, would be to really go through all your banks, all your savings and loans, and anything related like this, consumer loans, because the interest rate environment at this point is thought of as changing. Now we have the Fed next week, and so we'll hear from Powell, and that is going to be a big day, because if he ends up telling the market that, hey, no, the market, you think that we're cutting and we're not going to be cutting, then we're going to see a lot of gyrations, and it is going to be a tricky day. If he lets the market know that, hey, yeah, you guys are on the right course, then these trades should continue to work. But just be very careful when he talks. Is basically the reaction happens late on Wednesday when he talks, but the real reaction, I always say, happens on Thursday and Friday after everyone's been able to digest that. So next week is a tricky week. Lots of earnings, but to get ready for them, I would play through all of these and see any of them that are still in position. The Cooper, of course, is just a little bit extended at this point.
Yeah, and that is a double whammy, because not only do you have, again, the Fed meeting is Tuesday and Wednesday. The announcement comes out at 11 o'clock Pacific time, so that's 2 o'clock Eastern time. Then the press conference is half an hour after that, and that's where you often will see some gyrations, as he discusses his prepared statements, and then the questions come in and how he answers those. And then, as you said, then there's kind of the reaction as everyone kind of thinks about what's been said, and digest that Thursday. But all throughout that week, you also have earnings, so it is a double whammy. Definitely good to be very cautious, as you mentioned there, Mike. Any final thoughts? I know we've had a lot.
We've gone long. I just want to say it's really nice doing these with you. And if everyone doesn't know your nickname, could you tell everybody your nickname?
I have a lot of nicknames. I have no idea what you're talking about.
You know exactly what I'm talking about. Justin has been nicknamed by me many years ago the Saint, because he truly is a saint. He's pretty much a perfect person. And I've known him since 1998, and I've never seen him show his stress. Somehow I know that you must stress on some level. I've just never seen it. One day, do me a favor and show me some level of stress.
I'll take a video. I'll take a video and send it to you.
I think you might be a robot.
Very good. Well, hey, that's going to wrap it up for us this week. Don't forget, as we mentioned, we had a great discussion with Dan Fitzpatrick on IBD Live this morning. We're constantly bringing new guests on and returning to some old favorites. Brian Shannon is going to be on pretty soon. David Keller next month. Some really great guests that we really enjoy kind of getting those thoughts from them. Not to mention our regular panel, including myself, Mike Webster, Allie, Ed Carson, Ken Shreve, all your favorites.
And David Ryan on Tuesdays.
Can't forget about him. He's a regular as well.
I think that Brian, is next Friday. I'm really looking forward to that.
Brian Shannon. I mean, with his Anchored VWAP, I think I have his book right there.
I've
great.
Got him up there too.
We hope you join us for that. That's at investors.com/IBD Live. If you haven't taken a trial yet, as Mike suggested, definitely a good thing to do. And we will be back. Allie is still on vacation on Monday, but we will be trudging along without her. So hope you join us on Stock Market Today next week. We also have one other thing for you to take a look at. A Mark Minervini podcast that dropped yesterday. So take a look at that. Arusha and I, shared some time with Mark Minervini, two-time U.S. investing champion. Some great stuff that he shared about this stealth rally that's happening in the small caps and how he's handling it. So a lot of great education stuff for you. Hope you enjoyed it. Have a great weekend, everybody.